The safety of your savings rests on a promise. A promise backed by institutions designed to protect your money. But what happens when that system faces unprecedented stress? Recent events have raised questions about the stability of our financial infrastructure. We've seen banks falter before, leaving depositors to navigate uncertain waters. Now, a plan is being discussed, one that could fundamentally alter the relationship between your deposits and the health of the banks themselves. This is not about one bank's troubles. This is about a potential shift in how your money is viewed within the banking system. A shift that could see your deposited funds transformed into bank stock, with implications for every account holder. Understanding this potential change is crucial for anyone who relies on the security of their savings. 1. Introduction: the illusion of bank safety. The perception of safety within the banking system is often taken for granted. We deposit our funds, trusting they are secure, protected by regulatory bodies, and insured against loss. This trust forms the bedrock of our financial lives, allowing for daily transactions and long-term savings. Yet, this perceived security can, under certain circumstances, be more of an illusion than a guarantee. Consider the fundamental nature of a bank. It is a business that operates by taking deposits from customers and lending that money out, or investing it. The difference between the interest earned on loans and investments and the interest paid on deposits, along with fees, constitutes the bank's profit. This model inherently involves risk. Banks do not simply hold on to every dollar deposited. A significant portion is actively deployed in the economy. This operational reality means that a bank's stability is intrinsically linked to the performance of its assets and its ability to meet withdrawal demands. While deposit insurance exists to shield depositors from direct loss up to a certain limit in the event of a bank's failure, the mechanisms of resolution for a failed institution can involve more complex scenarios than simple reimbursement. The system is designed to maintain financial stability, and sometimes this involves measures that can alter the nature of depositors' claims. 2. What is the FDIC and what it really does? The Federal Deposit Insurance Corporation, or FDIC, is a U.S. government agency established in the wake of the Great Depression. Its primary mission is to maintain stability and public confidence in the nation's financial system. The FDIC achieves this by insuring deposits in banks and savings associations. This insurance protects depositors against the loss of their insured deposits if an FDIC-insured bank or savings association fails. This protection is not unlimited. The standard insurance amount is currently $250 per depositor per insured bank for each account ownership category. This means if you have multiple accounts at the same bank, the coverage applies to the aggregate balance within each ownership category. For instance, a single account holder with checking, savings, and money market accounts at one institution would have their total deposits insured up to $250. This limit is crucial for understanding the scope of FDIC protection. Beyond deposit insurance, the FDIC plays a significant role in bank supervision and resolution. It examines certain financial institutions for safety and soundness and compliance with consumer protection laws. When an insured bank does fail, the FDIC steps in as the receiver. It then works to resolve the failed bank in an orderly manner, often by facilitating a sale to a healthy institution or by directly paying depositors their insured funds. This process aims to minimize disruption to the financial system and protect the public's access to their money. The FDIC's actions are designed to prevent the domino effect of bank runs that plagued the early days of banking in the United States. 3. How bank deposits are legally treated. Bank deposits, from a legal standpoint, are not simply idle cash held by a financial institution. Instead, when you deposit money into a bank, you are essentially entering into a contract. This contract, governed by banking law and financial regulations, establishes a debtor-creditor relationship. The bank becomes the debtor, owing you the deposited funds, and you, the depositor, become the creditor. This distinction is crucial because it defines the nature of your claim on the funds. Legally, these deposits are treated as liabilities on the bank's balance sheet. They represent money that the bank is obligated to repay to its customers. This obligation is what allows banks to use these deposited funds for lending and other investment activities, forming the basis of the fractional reserve banking system. The depositor's right to the funds is typically secured by various mechanisms designed to protect against bank failure. In most jurisdictions, deposit insurance schemes, such as the Federal Deposit Insurance Corporation, FDIC, in the United States, provide a safety net. This insurance guarantees that depositors will recover their funds up to a certain limit, even if the bank becomes insolvent. This legal framework transforms a direct claim on specific cash into an insured entitlement to repayment, offering a layer of security to individuals and businesses. The legal treatment of deposits ensures that they are distinct from the bank's own capital or equity. While a bank's assets might fluctuate, the legal status of a deposit as a debt owed to the customer remains constant. This separation is fundamental to maintaining public trust in the banking system and preventing panic during times of financial stress. It is this legally defined creditor status that underpins the rights of depositors. 4. The bail-in mechanism explained. The bail-in mechanism represents a fundamental shift from traditional bank rescue strategies. Instead of governments injecting public funds to prop up failing institutions, a bail-in mandates that a bank's creditors and shareholders absorb losses. This means that the capital of the bank itself, rather than taxpayer money, is used to recapitalize the institution. This process typically involves converting certain types of debt and equity into new shares. For instance, bondholders might see their bonds converted into stock, thereby becoming shareholders. Similarly, existing shareholders could have their ownership diluted as new shares are issued to absorb losses. The goal is to ensure that those who have invested in or lent to the bank bear the consequences of its failure, protecting depositors and the broader economy from the direct cost of a bailout. The implementation of a bail-in is triggered when a bank is deemed non-viable or likely to fail. Regulatory authorities step in, assess the bank's financial health, and then initiate the bail-in process. This might involve writing down the value of certain liabilities or converting them into equity. For example, if a bank has a significant amount of subordinated debt, this debt could be converted into common equity to shore up the bank's capital base. This action directly reduces the bank's liabilities while increasing its equity. Historically, bank failures often led to taxpayer-funded bailouts, as seen during the global financial crisis. The bail-in mechanism, however, aims to prevent such scenarios. It establishes a clear hierarchy of loss absorption, with shareholders and certain creditors facing losses before depositors and senior creditors. This structure is designed to promote greater financial discipline among banks and their investors, as the risk of significant loss is more directly tied to the bank's performance. The process is complex and requires careful management to avoid triggering a wider systemic crisis. 5. How deposits can be converted into bank stock. In certain crisis scenarios, a bank's depositors might find their funds converted into equity. This transformation typically occurs when a financial institution faces severe insolvency, meaning its liabilities far exceed its assets. Regulators, tasked with maintaining financial stability, may implement a resolution plan that involves converting uninsured deposits into shares of the failing bank or a newly formed entity. This process, often referred to as a bail-in, is designed to absorb losses without necessitating taxpayer-funded bailouts. The logic is that those with the most to lose, like large depositors who exceed insured limits, become stakeholders. Their deposits are essentially exchanged for ownership, granting them a stake in the bank's future recovery. If the bank's value later increases, these new shareholders might recoup some or all of their converted funds. Consider a hypothetical situation where a bank experiences a run, depleting its liquid assets. If the institution is deemed too large or interconnected to fail, and standard recovery methods are insufficient, regulators might step in. They could force a conversion of uninsured deposits into preferred or common stock. This action immediately strengthens the bank's balance sheet by reducing its liabilities and increasing its capital. The conversion rate is determined by complex valuations of the bank's assets and liabilities. It is not a simple one-to-one exchange. The goal is to ensure that the value of the stock issued accurately reflects the portion of the deposit that can be recovered through this equity conversion. Depositors become shareholders, bearing the risk and potential reward of the bank's subsequent performance. This mechanism, while stark, aims to impose losses on those with greater capacity to absorb them, thereby protecting smaller depositors and the broader financial system. 6. Historical examples of deposit confiscation. History offers a stark reminder that deposit confiscation, while rare in modern developed economies, is not a theoretical concept. During periods of severe financial distress or political upheaval, governments have, in the past, intervened directly in the banking system to secure assets. These interventions were often framed as necessary measures to stabilize failing economies or prevent capital flight. One notable historical precedent involved the Cyprus banking crisis in 2013. While not a direct confiscation of all deposits, the restructuring of the nation's two largest banks involved a significant bail-in of uninsured depositors and bondholders. This meant that a portion of their funds was converted into bank equity, effectively making them shareholders in the struggling institutions. This action demonstrated a willingness to tap into customer assets to recapitalize banks. Earlier instances, particularly during periods of hyperinflation or war, saw more direct forms of asset seizure. In some cases, currencies were devalued drastically, rendering savings worthless. In other extreme situations, governments have outright nationalized banks and, by extension, controlled the assets held within them. These actions were typically undertaken in times of national crisis, where the survival of the state was perceived to be at stake. Such historical events, though distant, underscore the potential for extraordinary government action when financial systems face existential threats. 7. Why this matters during a banking crisis. The potential for deposit conversion into bank stock, as outlined in certain FDIC proposals, becomes acutely relevant during periods of systemic banking stress. When confidence in the banking system erodes, depositors often seek to withdraw their funds en masse. This phenomenon, known as a bank run, can rapidly deplete a bank's liquidity, forcing it into insolvency. In such a crisis, the FDIC's role as insurer is tested. If the agency is overwhelmed by the number of failures, or if the cost of insuring all deposits exceeds its reserves, it may explore extraordinary measures. The conversion of uninsured deposits into equity would serve as a mechanism to recapitalize failing institutions without directly drawing on taxpayer funds or the deposit insurance fund to the same extent. This strategy aims to shore up the balance sheets of troubled banks, transforming liabilities into capital. Historically, banking crises have demonstrated the fragility of depositor confidence. The savings and loan crisis in the United States, for instance, saw numerous failures that strained government resources. More recently, the global financial crisis highlighted the interconnectedness of financial systems and the rapid contagion that can spread from one institution to another. In these moments of panic, the distinction between insured and uninsured deposits can become a critical factor in determining the scale of a crisis. If a bank is deemed too large to fail, or if the failure of multiple institutions poses a broader threat to financial stability, the FDIC might consider such a conversion plan. It presents a way to absorb losses and maintain a semblance of solvency by converting creditor claims, deposits, into ownership stakes. This would effectively make depositors shareholders in the very banks from which they withdrew their money, a radical shift in the depositor-bank relationship that could profoundly alter the landscape of financial recovery. 8. Who benefits and who loses? In a hypothetical scenario where deposits are converted into bank stock, the primary beneficiaries would likely be the existing shareholders of the affected financial institutions. Their equity stake would increase as the capital base expands, potentially leading to a higher stock price and greater dividends. This sudden influx of capital, derived from previously insured deposits, could significantly bolster a bank's balance sheet, making it appear more stable and attractive to investors. Conversely, depositors would experience a direct and substantial loss. Their guaranteed access to funds would be replaced by ownership of stock, a volatile asset whose value can fluctuate significantly. If the bank's stock price subsequently declines, depositors could lose a portion or all of their principal. This transformation effectively shifts the risk from the deposit insurance fund to the individual depositor, who may lack the financial expertise to manage such an investment. Consider a small business owner with a substantial operating account. Under such a plan, those funds would become shares. If the bank's stock plummets, the business could face an immediate liquidity crisis, unable to meet payroll or supplier obligations. The FDIC, in this altered system, would no longer be a guarantor of savings, but rather a facilitator of this capital conversion, with its role shifting from depositor protection to market stabilization through equity infusion. The broader economic impact could be a chilling effect on public trust in the banking system. The expectation of insured deposits is a cornerstone of modern finance, encouraging saving and investment. If this guarantee is removed or fundamentally altered, individuals and businesses might seek alternative, less regulated avenues for their money, leading to capital flight and potential financial instability. The very mechanism designed to prevent bank runs could, in this context, inadvertently trigger them if the perceived safety of deposits is compromised. 9. What happens when a bank fails? When a bank encounters severe financial distress, a cascade of regulatory actions is initiated. The primary goal is to protect depositors and maintain stability within the broader financial system. This process often begins with the bank's chartering authority, which monitors its solvency and adherence to regulations. If a bank's capital reserves fall below required levels, or if it becomes unable to meet its obligations, regulators step in. The Federal Deposit Insurance Corporation, FDIC, plays a crucial role in these scenarios. Its mandate is to insure deposits up to a certain limit, currently $250 per depositor per insured bank, for each account ownership category. This insurance is designed to prevent bank runs, where large numbers of depositors withdraw their funds simultaneously, potentially bankrupting even solvent institutions. When a bank fails, the FDIC steps in to manage the situation. The FDIC's approach typically involves one of two primary methods: either facilitating a merger with a healthy bank or managing the bank's assets and liabilities directly. In a merger scenario, a stronger institution assumes the failed bank's deposits, often including those above the insurance limit. This ensures that most, if not all, customers can continue their banking relationship with minimal disruption. The acquiring bank receives incentives, such as loss-sharing agreements, to make the transaction more attractive. Alternatively, if a suitable merger partner cannot be found quickly, the FDIC may act as the receiver. In this capacity, it takes control of the failed bank's assets, such as loans and securities, and its liabilities, including all deposits. The FDIC then works to liquidate the assets to recover funds, which are then used to pay back insured depositors. For depositors with balances exceeding the insurance limit, the process of recovering those excess funds can be more complex and may take longer, depending on the value of the bank's assets. This structured resolution process is designed to minimize losses for both depositors and the deposit insurance fund, thereby safeguarding public confidence in the banking sector. 10. Final warning and conclusion. The implications of such a plan demand a final, sober assessment. It is crucial for depositors to understand that the FDIC, in a scenario where its own solvency is threatened, might be compelled to implement measures that fundamentally alter the nature of their insured funds. This is not a theoretical exercise. Historical precedents, though not identical, illustrate the drastic steps taken during periods of severe financial distress. Consider the systemic risk involved. If a significant portion of the banking sector faces collapse, the very foundation of deposit insurance could crumble. In such an extreme event, the FDIC's mandate to protect depositors could be reinterpreted or superseded by the necessity of stabilizing the financial system. This could involve converting uninsured or even insured deposits into equity, effectively making account holders shareholders in failing institutions. The transition from depositor to shareholder is not a minor adjustment. It shifts risk from the institution to the individual. Shareholders bear the ultimate responsibility for a company's performance. Their investment can be wiped out entirely if the company fails. This is a stark contrast to the fixed, insured amount that depositors typically expect to recover, regardless of a bank's profitability. Therefore, a comprehensive understanding of deposit insurance means acknowledging its limitations during unprecedented crises. While the FDIC's current structure and regulations aim to prevent such scenarios, the potential for a radical redefinition of depositor rights in a systemic meltdown remains a critical, albeit unlikely, consideration. Vigilance and informed awareness are the primary defenses for individuals navigating the complexities of modern banking. The FDIC's role as a backstop for depositors is fundamental to financial stability. However, understanding the mechanics of deposit insurance and the potential implications of systemic stress is crucial for all account holders. This plan, while designed to protect the broader financial system, raises important questions about the nature of your deposits. As we've seen throughout history, from the savings and loan crisis to more recent events, the resilience of our banking infrastructure is constantly being tested. What happens when a bank fails? The FDIC steps in, but the process can be complex. It's not simply about getting your money back dollar for dollar in all scenarios, especially when considering the intricate web of bank capitalization and potential conversions. This investigation has highlighted the critical need for transparency and public awareness regarding these mechanisms. Your deposits are the lifeblood of the banking system, and understanding how they function, especially under duress, empowers you as a consumer. In our next segment, we will delve into the practical steps individuals can take to diversify their financial holdings and build personal resilience against unforeseen economic shifts.